Let's practice inventory cutoff concept and inventory balance calculation. Before we start, subscribe to our channel for more videos. Here you see an information about the balance of inventory as of 2024 end. Under the perpetual inventory system, the company showed $47,800 at December 31, 2024. Year-end cutoff procedures were sloppy, and several events occurred. Let's overview them one by one.
At 2024 year-end, there were 5 events. The cost of goods related to these events impacted year-end inventory balance. The cost of goods related to the first 3 events was included into the inventory balance. The cost of goods related to the last 2 events was not included into the inventory balance. Event number 1. Some goods were shipped to a customer on January 3, 2025. The sale of these goods was recorded in 2025. The cost of these goods is $6,600.
Event number 2. Goods received during 2024 were recorded twice in the inventory account. The cost of these goods is $5,200.
Event number 3. Goods shipped to a customer on December 27, 2024, FOB shipping point, were not received by the customer until January 2025. The cost of these goods is $9,300.
Event number 4. Some goods received on December 30, 2024, were recorded as received on January 3, 2025. The cost of these goods is $13,500.
Event number 6. Some goods on hand at year-end were never recorded on the books. The cost of these goods is $7,400.
Let's analyze whether cost of goods related to these events was correctly recorded. And what is the correct value of inventory as of December 31, 2024? Before we start, let's revisit what is inventory cutoff and why this is an important concept. Inventory cutoff is the process of ensuring that all inventory transactions, both purchases and sales, are recorded in the correct accounting period. Why inventory cutoff is important? First, it secures accurate financial reporting. It ensures that inventory, cost of goods sold, and revenues are recorded in the correct accounting period, preventing misstatements in the financial statements.
Second, it secures proper profit measurement. Inventory cutoff aligns costs with related sales, allowing for correct calculation of gross profit and net income.
Third, it is related to audit and compliance. Inventory cutoff demonstrates adherence to accounting standards and strengthens the reliability of financial records during audits.
Now let's see whether cost of goods related to each event was correctly recorded. These goods were shipped on January 3, 2025, which is after the balance sheet date of December 31, 2024. At year-end, the company still owned and physically held the goods, and the sale wasn't recorded until 2025. Therefore, it is correct that the goods were included in the December 31, 2024 inventory. No adjustment is needed.
These goods were received during 2024, so they should be included once in inventory. However, they were recorded twice, which means the ending inventory was overstated by $5,200. The duplicate amount should be excluded to reflect the correct inventory balance. These goods were shipped on December 27, 2024, under FOB shipping point terms. This means ownership transferred to the customer when the goods left the seller's premises, not when they were received. Even though the customer didn't get them until January 2025, they were no longer the property of the company as of December 27. Including these goods in ending inventory is incorrect. They should be excluded, reducing inventory by $9,300.
These goods were physically received on December 30, 2024. So they were owned by the company at year-end. However, because they were recorded on January 3, 2025, they were left out of the 2024 inventory balance. This is an error. These goods should be included, increasing ending inventory by $13,500.
These goods were physically on hand at year-end, which means the company owned them as of December 31, 2024. However, they were never recorded in the inventory account. So the ending balance is understated. These goods should be included, increasing inventory by $7,400.
Now let's summarize and calculate the correct ending inventory balance. First event was properly recorded and had no impact on the year-end inventory. Second and third events overstated inventory, therefore decreasing year-end balance is needed. Fourth and fifth events understated inventory, therefore increase in year-end balance is needed. After the corrections are done, inventory balance as of December 31, 2024 is $54,200. Thank you for watching. Subscribe to our channel not to miss new videos.